There are decades where nothing happens, and there are weeks where decades happen. Right now, it very much feels like we're experiencing the latter. Major tax reform is moving, the U.S. is leading an upheaval of the global trade order, and amidst this backdrop, markets may be telling us the time has officially arrived to be concerned about the U.S. fiscal outlook. What does this critical inflection point mean for the economy, and how investors should allocate today? As mentioned in the introduction, what's driving markets today are the tariff and trade developments and concerns regarding fiscal sustainability, which are increasing as a result of the current tax bill moving through Congress. In today's discussion, we will build upon the analysis we provided in Q2 edition of Mapping the Markets. In Mapping the Markets, we highlight the charts and data we believe are most timely and relevant for investors, sharing our views across macro and rates, as well as public markets, private equity, private credit, and real estate. It's a detailed expression of how we think about these markets, and importantly, always focusing on you, the investor. To start the conversation, I'd like to bring in our leader in research, someone who's a disciple of his profession as a market analyst, leading efforts across everything we do, and especially in the area of macroeconomics, which is what we'll primarily focus on today. Andrew Korz, welcome.
Hey, Alan. Thanks for that very nice intro. I appreciate it.
Of course. So I want to start today's conversation simply reflecting on the significance of the moment that we're in today. You know, as someone charged with making sense of the world and bringing that home for our clients, you know, what's your assessment of the gravity of the situation we find ourselves in today?
Yeah, I guess you never really know the gravity of the situation until, ex ante. But I think there's a couple things going on right now, right? I think we've talked about this a lot in a couple of our recent pieces, that there are transformational changes we think happening underneath the surface of the global economy, the geopolitical landscape, that are real sort of era-defining shifts, I think, that are going to have massive implications across many different, factors, but, investing included. I think sometimes that then gets ported into the more short-term stuff as well, where it feels like everything is this sort of existential, concern. And while some of those might be the case, and I think we'll get into some of this today, I think it becomes a little bit challenging to sort of sift through what's signal, what's noise, and in today's environment with tariffs and this budget bill and trying to understand the economic data and the wars that are going on around the world. I think it is a challenge to sift through that, but that's our job, right?
Yeah. And, you're someone who I know loves diving into the data, and pressing the last piece into the puzzle to figure out, how it all comes together. So, I mean, just on a personal level, is this exciting for you professionally to have this much going on?
Exciting, exhilarating, stressful, time consuming. I think, you hear, I'm sure you hear the same from folks, who have been in the industry a long time, who talk about, the GFC or the early 90s or the dot-com bubble or, whatever it may have been, the periods that sort of defined their careers and sort of where they cut their teeth during those periods. And for those of us who started in the industry post-GFC, I think certainly COVID and now this period, I think we'll look back on at some point as sort of those defining points in this, what I think will be a sort of a new investing era. Yeah,
no, for me personally, I mean, it's been a period where the emphasis on continuing to learn and learn and learn, is deeply important. I mean, reading through and learning about different sections of trade acts, that were passed decades ago, learning about reciprocity agreements and, how trade deals get done and what those timelines look like and what all, those involve, has been an exciting thing for me as a professional in this industry to explore new horizons and get a firmer grasp of a wide range of concepts.
Yeah, agreed.
So, I mean, that leads us well into, the first topic, which is, the latest on tariff news. Obviously, there's headlines everywhere. How do we kind of cut through that, summarize it down for folks?
Yeah, so I think, there's a reason we keep doing these tariff episodes, right? Because it keeps changing, and we're trying to get a grasp on what is the end state, right? Like where does tariff policy end, and what does that mean for the economy, for the markets, et cetera? And so here's where we are sitting here at, 10:52 a.m. on June 4th?
June 4th.
Yeah. So here's where we are today, right? So maybe let's just talk about what the categories of tariffs we have today are.
Sure.
So we've got the broad 10% tariff on most imports from around the world. We've got these fentanyl-related tariffs that are imposed on non-USMCA compliant goods from Mexico and Canada, as well as most goods from China. Both of those are imposed under a statute called IEEPA, which is the, see if I can get this, International Economic Emergency Powers Act.
Flipped economic emergency.
Darn, I almost got it. Okay.
I had the benefit of having it right here in front of me.
So that act was passed in 1977. So under those, under that act is where we get sort of the broad 10% tariffs plus the Mexico, Canada, China, part of the China tariffs.
Sure.
Then you've got other parts of the tariff code, which are the sector-specific tariffs on autos and auto parts, aluminum, steel, which were just hiked to 50% from 25%. And then you've also got the third thing, which is what are called Section 301 tariffs from Trump 1.0, which covers about $370 billion worth of Chinese imports. Recently, a federal trade court struck down those IEEPA-centric tariffs, so the 10% across the board, the Mexico, Canada, 20% on China, fentanyl tariffs. Those were struck down. They were then granted a temporary stay. So they're still in effect as of today, as we speak. But those could very well get struck down. It'll go to an appeals court. It could go to the Supreme Court. I think, we'll see how that plays out. I think the administration has options should they get struck down. There's other parts of our very Byzantine trade laws that should allow the administration to impose fresh sweeping tariffs across the world for 150 days. So it's temporary, but it could fill in for some of those broad tariffs. They could then start new investigations under Section 232 and 301. They've already done that for pharmaceuticals, for lumber, for copper, which we expect will go into effect later this year. They could do the same for other countries under Section 301 and then impose country-specific tariffs. So there's a lot of things this administration can do, and we think that they will probably utilize all of the tools at their disposal. But I think, we just went through a lot there. I think the broad story here is for, the market's sort of been pricing in this gradual decline in uncertainty, movement towards lower tariffs, trade deals. We got the trade deal with the UK. I think folks are a little bit Pollyannish to think that, the tariff policy is going to go in one direction. I think this court ruling could actually stoke more uncertainty. It could force the administration to use more legally sound parts of the trade law to impose tariffs, and ultimately, we think this tariff uncertainty is here to stay for the long term.
Right, and what you've kind of gone through, just to summarize, is a little bit of the tactics of the administration to arrive at where we are today. I mean, the use of IEEPA initially was kind of the fastest to market. The way in which that could get rolled out. You didn't have to do the trade investigations to enact the 232 section tariffs. And, now that that's being challenged, it's given them some additional time to do the investigations in the trade courts, present that case, to then have tariffs enacted that have more statutory authority and have more lasting impact, where the administration's got a stronger legal basis. So it's not that necessarily tariffs are kind of going unidirectionally like you described. It's that the administration seems to be more coalescing around, ways in which they can, get back to, implementing certain tariffs that they intended to in the first place, but do so on a stronger legal basis.
I think that's right. And I think their willingness to utilize all tools at their disposal makes it pretty clear that this is a policy that they believe in long term.
What are kind of the leading, areas of concern from your perspective?
Yeah, so I think about tariffs as sort of as having sort of a dual policy effect. On one end, they are a tax. So taxes are fiscal tightening, right? They're restrictive, and they act to sort of slow the economy down. On the other hand, they can act as a supply chain disruption as well. I think the higher the tariff rate is, when tariffs on China were 145%, that essentially was going to end trade with China, which would act as a massive supply chain disruption, right? When they're a little bit lower, like they are today, it acts more like a fiscal tightening. Again, you're taxing importers. So you're either basically increasing taxes on companies, or if those companies pass some of that cost on to consumers, you're taxing consumers via higher prices. So it does sort of act in a similar way that other taxes do, to kind of put it simply, right? So in May, the U.S. raised about $24 billion worth of tariff revenue. That annualizes to about $300 billion a year. If we sort of look at other parts of the tax code and say, what would get us a similar $300 billion impact, roughly 1% of nominal GDP, right? So similar impacts would come from basically a 3% increase in personal income taxes. So currently the effective tax rate that Americans pay is about 15%. If we raise that to 18%, it would be a similar impact. Currently, the effective corporate tax rate is about 18%. If we raise that to 28%, so increased it by 10 percentage points, you get a similar impact. And then another way to look at it too is higher oil prices is also sort of a de facto fiscal tightening. If crude oil prices went from $60 a barrel, which is around where they are today, to about $100 a barrel, you'd get a similar sort of fiscal tightening impact. So there's other sort of ways that you can measure this to make it more salient for people to understand. In my view, those are significant impacts. Are they enough to put us into a recession? It depends, but I don't think it's certainly any type of foregone conclusion. It's a 1% hit to GDP, right? So if we came into this year expecting 2 to 2.5% growth, maybe your new base case is 1 to 1.5% growth.
And that context, I love the way that you frame it out in terms of things that people are more familiar with and directly, reactive to. Because tariffs in most people's lifetime is a relatively new concept. People still kind of don't really know how to assess it. I'm talking about consumers, households. What would the impacts be? But when you frame it, in a very simple example of like if oil went from $60 to $100 a barrel, people grasp that.
Yeah, the distributional effects will be very different, right? Tariffs are more targeted, so they're going to affect certain industries, certain sectors of households, et cetera. So the effects will be different distributionally, but just speaking from a macroeconomic standpoint, those are sort of some of the similar ways that we can think about it.
And so in terms of the GDP impact, obviously a big part of this policy is stimulating more investment in the United States, particularly including foreign direct investment. You have the announcement of the Nippon Steel, U.S. Steel deal, to protect a bunch of jobs and secure some additional investment. A lot of what we've seen thus far are announcements. I think it's important to level set. $10 trillion in announcements does not mean that money is getting deployed in the economy.
No.
This quarter, next quarter, this year. And we've seen previously, and this is across party lines, major economic announcements that ultimately kind of fall flat and don't come to fruition. I think we're all hoping that these come to fruition. We're talking about major investment in data, infrastructure, AI-related technologies, kind of that next era that could fuel a boom in American manufacturing and industry and technological advancement. But I think it's a word of caution that that takes time to get those dollars in the ground and actually see those effects. And in the meantime, there are some real tangible effects because the policies come before the action here.
Yeah, I think that's 100% right. And, we'll see how much, we've seen massive, investment promises from the likes of Apple and SoftBank. And I think the UAE just promised like 3 times their entire GDP as an investment in the U.S.
It's aggressive.
So, that's bold, but we'll see. Regardless of what those promises or announcements actually come to mean in the coming years, I think what's acting against the administration's goals right now is the uncertainty on tariffs, right? And we've talked about this a lot. If you tell people what tariffs are going to be, they may not like them, but they'll figure out ways to deal with them, right? And it may, over the medium term, cause them to pull some supply, some capacity back home, or at the very least to more allied countries. Right now, what you have is massive uncertainty, and you see that in any CFO survey, purchasing manager survey, et cetera. Anybody who's asked about expectations for capital investment over the next 6 months, it's plunged, right? Because people just don't know what the tariffs are going to look like, and they want to wait to see when there is more certainty, and then they can make decisions, right? So I think, to your point, there is this big timing mismatch between what are the goals and what's happening on the ground today if you're a business leader making these decisions. And that's a really hard thing to square because these are long-term investments, right?
And, there's another, I keep using analogies to things that people are more familiar with because there's just a little bit more history to it. But I think there's a good parallel here with, the regulatory environment. If you talk to business leaders, they don't like to have more regulations, but the thing that they really don't like is to have new regulations all the time.
Right.
Because if they know where the playing field sits, they can go out and operate, make their businesses efficiently, and make sure that they comply.
Yeah.
That's almost as important as deregulatory environment for a business leader. And I think the tariff example and analogy to that, just that uncertainty is what freezes up activity and causes that hesitancy to really make the capital investments that we need to be happening in order to offset some of the concerns for consumption.
It's part of the challenge of the U.S. political model, right? We have a lot of elections. We have a lot of, especially recently, every election's been a change election. You get these, one party sweeps in, the next party sweeps in 2 years later or 4 years later. And when you're competing against the likes of China and for better or worse, their political stability based on, intense control over their populace, they don't have these issues. And when you're talking about long-term investments, it's challenging to get that type of certainty for businesses right now.
So we're looking at long-term estimates about the fiscal impact of tariffs and trade policy and, a whole variety of things associated with the tax bill. The question is, will there be the political will to stick with some of these things beyond 4 years?
Yeah.
The House has now passed the big, beautiful bill, so to speak, on May 22nd. And, estimates of that bill include that it would add, $2.4 trillion to the national debt, between 2025 and 2034. And, estimates increase for the next 30 years thereafter to about 11 trillion. There's also a Ways and Means title that would be expected to add an additional 18 trillion to the national debt of the 2025 to 2055 window. So, these are very sizable numbers, and it comes at a time when you're seeing, longer dated treasury bonds sell off. There's been an aversion to U.S. denominated assets. You've seen the currency depreciate. You don't typically see a widening. Our textbooks that we studied in college would say that when, benchmark rates go up, capital inflows to collect the higher rate. But we're not seeing that. We're seeing a diversion between those two lines.
Yeah, no, that's right, I think. And a lot of people, I think, have laid that at the feet of this budget bill that, people look at the numbers you just cited and, it widens the deficit by, I think, $2.5 trillion over the next 10 years. I think, importantly, a lot of the measures expire before the 2028 elections, or right after the election, I should say, so that, the Republicans can run on those issues. But if those get extended, it could actually be more expansionary.
The estimate is up to $4 trillion over the same period if those temporary provisions get expanded and made permanent.
I think it's important for a little context here, though, because part of what's important is those numbers, 2.5 to 4 trillion, whatever it is, those are being compared against what is called the policy baseline.
Sure.
Right? And in many cases, the policy baseline that's being used is, if you recall, in 2017, the Tax Cuts and Jobs Act was passed, cut corporate taxes, individual taxes, et cetera. That was set to expire at the end of this year, right? So the policy baseline we're talking about is that big tax cut expired and taxes went up at the beginning of next year. That's not really a real policy baseline, for being frank, because the Republicans were never going to let that tax bill expire. So if you're using sort of actual, if you take that tax bill extension as a given, this bill actually doesn't really widen the deficit all that much over 10 years. It does a little bit, but there are significant offsets in the House bill as well. There's Medicaid and changes to food stamps and things like that. And actually, if you compare it to the estimates of Trump's campaign rhetoric, what he was talking about, those estimates for the deficit expansion were much higher, actually. So I'm skeptical that this was unexpected, frankly. I think we can argue about the merits of the actual policies within, but I think thinking from a macro standpoint and the actual expansion of the deficit, I actually don't know if that's materially what's driving this interest rate issue that you've discussed. And actually, rates are down this year. So first we'll say that. So are growth expectations, but rates are down this year. Obviously, the currency's weakened. I think that is due to the trade war and other countries being less confident in, the U.S. assets and things like that. So I think this might be part of it, but I would hesitate to say that this type of budget was unexpected, and B, that it is primarily what's driving some of the volatility in interest rates that we've seen.
And, the assumptions in terms of the budget increase, the, fiscal deficit increase, isn't that based on, a 1.8% GDP growth rate from the CBO?
Yeah.
So, that could be...
There's lots of assumptions that go into this. The other assumption is that the 10-year is going to glide down to about 3.8%, which... Again, as we build up debt, the most important thing to our fiscal sustainability is the level of interest rates, which is a whole other discussion we don't need to get into. But there's a lot of assumptions that get put into this that may or may not end up being true.
Yeah, and I think ultimately, the concern that we have as we sit here today is policies come before action, and the policy on the trade and the tariffs, came before provisions in this tax cut and extension that would be stimulative to help offset some of those impacts. And there are, several elements of this bill, that would, seek to stimulate more capital investment, deductions for R&D being able to be taken immediately, full expensing of qualified property, some expansion of, pass-through deductions for qualified business income, all things that would help, finance, that large capital investment. And also, allow businesses to, manage their cash flow better, take that expense today, get that kind of tax benefit accrued over the life of the project. And so, those things would be stimulative to the business investment that's needed to offset some of this and kind of achieve that more reindustrialization, domestic manufacturing aim. The only concern is that the amount, of these programs seems to be relatively small against the seismic need of capital and, frankly, federal support that's needed to, make this significant of an economic shift.
Yeah, and at the same time, it also rolls back a lot of the Inflation Reduction Act funding, which, you can agree with it or disagree with it, but it certainly did direct funds to clean energy, battery, EV projects. So, removing that funding is meaningful macroeconomically as well. Yeah,
I mean, the thing that I always say is whether you agree with the source of the spending or not, spending is spending when it comes to counting up GDP.
Absolutely.
So there's, obviously a thin line that we're kind of walking here in terms of the policy, the trade, and ultimately the macro impacts. We've outlined, some of the potential causes for concern. And so you see a lot of Wall Street banks increasing their forecasts for recessions, this year into next year. Obviously, folks are a little shaky. The most popular word on Wall Street right now is uncertainty.
Indeed.
Uncertainty is never a good thing when it comes to capital allocation and investment.
Or just in life in general, it's a bad word generally.
I agree. I'm like the person who goes to the same restaurant almost every week.
Yeah.
Very regular. I've got like 5 restaurants and in a city with wonderful restaurants everywhere.
We got to get you more spontaneous, man.
Well, I just know, I'm certain that every time I go, it's going to be a great meal. Service is going to be top notch. And I'm going to leave there very satisfied with the meal that I've had. So, I mean, I put a premium on certainty.
Sure.
Andrew wants to be a little bit more eclectic and try things out. He's got a little bit more of an appetite.
Sometimes it ends in a bad stomach, but it is what it is. We deal with it.
So, again, folks like me tend to be the ones that are, speaking up in times like this of uncertainty. So, what is needed to kind of calm the markets? What is our outlook for a recessionary event?
I would say 2 things. The certainty around tariff policy, as you pointed out, and the actual policy matter, right? So if you go back to Liberation Day, if you look at those rates, that was going to push our effective tariff rate up to 25%. That would have almost certainly put us into a recession. Today, we're closer to 14-ish% effective tariff rate, so much lower. And if the IEEPA tariffs get struck down permanently, it'll be closer to 9 or 10%, right? So meaningful improvement there. And I think, look, our base case is no recession. So we came into the year, the labor market was strong, corporate earnings were accelerating. There were a lot of things that, the starting point was pretty positive. And certainly, again, tariffs act as a tax. That's going to slow the economy. a lot of the stimulative effect of the new tax bill is just extension of old policy. So it's actually not going to be all that stimulative. So net, I think we can expect a restrictive stance coming from the government of about, close to 1% of GDP, as I mentioned. So look, I think if we came into the year expecting 2.5% growth, closer to 1.5%, if this uncertainty continues, that is a downside risk, right? That 1% does not bake in uncertainty that causes businesses to stave off investment, that causes consumers to increase their savings and not spend and not take vacations, right? So that's the downside risk there. But look, the U.S. economy is resilient. Again, the labor market right now is strong. It's allowing for solid income growth. That means that folks can actually pare back on spending while increasing their savings, right? So our base case continues to be slower growth, no recession. I think the market certainly agrees with that right now. I think we're trading at almost 22 times on the S&P 500. If you look at prediction markets, which have gotten very popular these days, the odds of a recession in mid-April were around 2/3. It was almost a certainty. Today it's 30%.
Sure.
It's a bit higher than normal, which is like 20-25%, but 30% is not anything to sort of be super alarmed about. So I think that's what people have coalesced around, and we'll see where policy lands. But the U.S. economy has been, very resilient throughout this post-COVID period, and I think we opt toward erring on that side right now.
Yeah, and if I could, I think the bull case, for me, the thing that I worry about the most is a significant uptick in inflation as a result of some of the policy that's going on right now, and that really gets baked into consumers and businesses' minds. I mean, inflation is a real intangible thing, but it's also a psychological thing. If you think that prices are going to be higher, a week from now, a month from now, a year from now, you've got to bake that into your forecast in terms of how you deal with your customers, how you deal with your suppliers. This whole, menu cost issue that you read about in your economics classes of, you don't want to change prices too much. I feel like the world's kind of shifted away from menu costs being an issue. I mean,
certainly since COVID, yeah. Companies were like, we can raise prices.
Every time I go to a restaurant, I order through a QR code and the price is different every time I go.
Yeah, dynamic pricing has become a real thing.
Exactly. And so I think that ability to bring inflation into the market from, that sort of activity is something that gives me real cause for concern, because that'll obviously keep, the Fed more restrictive territory for a period of time. It'll keep the long end higher for a period of time. And, ultimately one of the things that we need to get, real growth stimulated and get back on that hockey stick upward is for merger and acquisition activity to tick up, for deals to get done. There's a lot of capital that's ready and looking for deals. Yeah. But the current, financing conditions at these level of rates just aren't as conducive to it. So again, I think the way you get deals done, you get that certainty around the policy stance. Maybe you get some help from certain provisions of the tax bill, but then ultimately inflation's got to be under control well enough so that way rates can start to fall again and get some money in motion. Yeah,
no, I think that's certainly the bull case that we came into the year thinking we were going to get.
Sure.
Will we get that, sort of pure version of it? I don't think so. But could we get closer to it than we are today? I think absolutely.
And so, we always bring it back here to what does it mean for our clients? What does it mean for our investors? Like, what does this mean for investors in public stocks, large cap companies? How does this affect the outlook for that segment of the market?
Yeah, look, the S&P 500 is up on the year now, which is remarkable. We were in a bear market in mid-April, and we're up, 20% since then. The Mag 7 have led that. So, if you had, it's been a wild year for the Mag 7. You had the DeepSeek thing early in the year, and then you had the tariffs, or you still have the tariffs, but you had Liberation Day. And the Mag 7 has really kind of trucked through, despite the fact that we have a chart in our Mapping the Markets that shows that each of them has roughly 50% international revenue exposure. They have, at least on the cost side, at least 20% of their revenue cost of goods sold comes from abroad.
Sure.
And for Apple and NVIDIA, I think it's Apple and NVIDIA. No, sorry, Apple and Tesla, it's closer to 50%. So meaningful, and I think we know that about Apple, right? They're kind of the archetypal, sort of face of globalization. So there's real risks there, right? And I think what we've seen over the past, call it month, is that as the market has recovered, the dollar's also fallen, which has been a tailwind for earnings expectations for foreign-focused companies. When they make money abroad, they bring it back. They get more dollars for the foreign currency that they earn abroad. That's been a tailwind. But we came into the year and we're still around 22 times earnings on the S&P 500, right? And earnings expectations have only fallen about 1% for the next year. They haven't gone up. Usually they go up. They haven't gone up, which is, I think, because of some of the uncertainty we have, but they haven't really gone down either. So I think there's still material risk to the downside for large cap earnings expectations. And if that's the case, I think, look, the way we're pricing equity markets right now is a return to sort of a much more normal environment. And in my view, the risk to that is to the downside.
One of the charts that I love the most in our Q2 edition of Mapping the Markets, which should be out now, please go and click link in the show notes, is the chart where you show the percentage of S&P 500, foreign revenue increasing over time, overlaid with S&P 500 corporate margins.
Yeah.
And the pairing of those two lines across the chart is so narrow.
Yeah. So the chart you're talking about is the percentage of all U.S. corporate profits that are earned by subsidiaries of U.S. companies, right? So Starbucks China selling coffee to Chinese citizens would be an example of this. And it's gone from 5% 4 decades ago to over 25% today. And look, we've talked about this a lot. There's the impact of, sort of tariffs on costs and, retaliatory tariffs on your revenues abroad. But there's also just the views towards U.S. goods and services writ large, right? There was a poll done by YouGov recently that polled various European countries or, citizens in various European countries, asking them, will you boycott or look to not buy U.S. goods and services? And it was like 40 or 50% said either definitely or probably. Yeah. That's, that may change, right? This may blow over and we all might sort of, kumbaya and clap at the coming together of the Atlantic, relationship. But I think for now, there are real risks that foreign consumers look to sort of get away from U.S. goods and services.
Sure. I mean, one of our big themes is kind of a decoupling of the world in a more insular world, and not just because of what the U.S. is doing, but it's happening around the globe. When you look at political winds in different parts of the world, that kind of view toward a more homogenous economy, more domestically oriented, shows up, and it shows up not just in policy, but in terms of consumer expectations and demands and, favoring national brands over international brands. And so, when so much of your margin expansion over that period of time has been driven by those foreign operations, that does pose a significant risk to the large scaled multinational businesses.
Yep. Do you want us to take us briefly through your thoughts on the credit markets, given you're our credit expert on the team?
But there's a lot of dynamics going on there. And I think in mapping the markets, I describe the situation in credit as somewhat like forced optimism. If you look at the levels that markets and public credit are pricing spreads on a historical basis, you'd say, oh, wow, the market's extremely optimistic about the outlook on defaults and the prospect of forward returns and, rate moves in high yield, to support the total return. When you look at the supply technical factors, your assessment might change. It's more of that, I don't necessarily believe that I should be as optimistic as I am, but there's so little supply of new credit into that market. 90% of volume over the past 2.5 years has gone to refinancing and repricing. There's not a lot of new originated credit that's coming to market. Most of that is shifted over to private credit. If you want to finance M&A activity, if you want to finance LBOs, credit that has kind of a growth impulse behind it over the life of the loan, you've really got to go to private credit markets. And as a result, the demand has just outstripped the supply in both the syndicated loan and high yield bond markets, to the point where spreads are now, implying forward default rates of sub 1% in high yield, sub 2% in syndicated loans, which is well inside of where current trailing 12-month default rates are. So you've got to expect that all of this uncertainty that we've talked about thus far really doesn't come to fruition and affect these borrowers, even though it's a higher rate environment. Syndicated loan variable rate borrowers continuing to pay an elevated interest rate, high yield bond borrowers starting to refinance into higher rates. But again, so much of the market has shrunk. You've had so many companies that have been upgraded out of the high yield universe as opposed to companies that have fallen into the high yield universe. So, it's just a market where, because of its shrinking, it might be a situation where it's really a demand outstripping supply and keeping those spreads really tight. And I bet you any credit investor would say, man, I'd love for spreads to be wider. I don't necessarily love where they are here. But if you have to deploy capital, you don't really have an option.
Yeah, I think we can agree that there's a lot of complacency and optimism about the short term baked into public markets today.
Mm-hmm. But it does give a good opportunity to kind of broaden out that horizon on the private side. You have seen spreads come in a bit in the upper middle market of private credit, but in other areas of private credit, kind of your lower core middle market, especially in non-sponsored lending, much less penetrated markets. There's not as much capital flowing into those markets. They're not as sizable of deals. You've really got to do your own underwriting. That is where the compensation, for the risk that you're taking, typically lower leverage, better loan documentation, that is an attractive area of the market. And the smaller companies are the ones where M&A is still very active.
Yep.
Private equity sponsors are still putting capital to work. So the opportunity to finance real, genuine growth there is available in that segment of the market in particular.
Yeah, I mean, I think that's what you see in private markets, to sort of put it simply. I mean, the two things that are challenging folks the most today are, this sort of attack by the U.S. on the globalized, internationalized order that companies have flourished in over the past 4 decades, and higher interest rates, right? And both of those things are bigger challenges to larger firms, right? Larger firms that are more highly levered and more, from a revenue and cost standpoint, more exposed internationally. And to your point, those firms, and whether it's credit or equity, are priced at a premium right now, despite those challenges, right? Because there's just been so much capital that's flown there.
Sure.
In the lower parts of the market, whether it's, lower core middle market private equity, lower core middle market private credit, they're, more domestically focused firms from an operational standpoint. They're, they generally have lower leverage. And to your point, there's actually sort of a premium built in there, whether from wider spreads or from lower entry valuations, that can help address the significant concerns in public markets, which are higher valuations, really tight spreads today.
Yeah, it really is the perfect offset. We have some questions from around the firm. A new segment for our podcast, and we've reached out to teams around the firm to see what's top of mind for them and for the financial advisors that we work with and their clients. And so the first question that we have is, I've heard questions that a reduction in M&A deal flow will affect our ability to make loans in private credit, and that endowments, Yale and Harvard in particular, are reducing their exposure to private equity. And there might be some impacts across the space, both in private credit and private equity, related to these developments. Do you want to take part of that to start?
Sure, yeah. I mean, I think, on the private credit side, what we've seen, especially since Liberation Day, is certainly, M&A has not rebounded the way we expected this year because of the uncertainty. It's actually it's not like it's gone away, and especially in the lower parts of the market, like you mentioned, but the rebound hasn't been there. And that's the lifeblood of regular way sponsored private credit. The offset, and we've talked about this a lot because it happened in 2022 and 2023 as well, is when you do get these periods of volatility, you tend to get much less competition from public markets, right? Especially the syndicated loan market.
Right.
So what you see is issuance in that part of in the public space, plummets. And even if M&A activity falls somewhat, the share gains from private credit, because they are long-term investors, right, locked up capital, who can put money to work with a more long-term view on the credit, they can take share significantly from public markets. That's what we saw as the Fed raised rates, and then you had the bank failures of early 2023. And I think that's what we're seeing in sort of Q2 this year as well. And then on the endowment sales side, Yale's the big one. I think $6 billion they may be coming to market with. The private equity market is massive. I would caution against putting too much stock in. Endowments are an important institutional investor type. They are not the largest by any means. I think what it does do is it speaks to the increasing maturity and liquidity of the secondaries market,
right, and
the attractiveness of being a player in that market today. Number one, with the challenged exit liquidity, and number two, with the amount of supply coming to the market, you can potentially get significantly more attractive pricing.
Sure, and to that latter point, the secondary market has grown. Much more sizably. I mean, the latest year was roughly 160 to 180 billion in volume. So, there's been much to be made about Yale and some other endowments bringing, $6 billion transactions and, slightly lower than that to the marketplace. The market is well developed enough and there's enough capital allocated to that space to where it's not like these deals are going to crater, pricing in that market. There's plenty of buyers that are willing to look at good quality assets, take a view on those and make a bid.
And it's a good time to be a buyer.
Exactly. So our second question from the team is, our team continues to get some pushback from financial advisors of all type, large and small, regarding private credit and their concerns about it being, quote, crowded. What are your thoughts on that, Andrew?
Yeah, I mean, is this the number one question we get?
I think we get this question the most about whether private credit...
And we've been getting it for a while now.
And we've had to write pieces to address it.
Yeah. Look, I think it's a fair question given the amount of headlines you see in the financial media about private credit. And, somebody will take a one-off deal and talk about how that's representative of the entire market. I think the reality is, are there competitive pockets of private credit? Yes. Especially in the upper part of the market where there's been tons of capital raised. If you take private credit as sort of a holistic market, right? A $1.7-2 trillion market that it is today, most of that's direct lending. If you look at the amount of direct lending dry powder sitting in funds today, right? It's about $180 billion. So that means, basically private lenders, they've raised this money, they have to deploy it into loans over the next, call it year and a half, right? The amount of deals being originated by those same lenders every quarter is about $60 to $70 billion today, right? So even if you assume, 20 billion or so a quarter of fundraising to sort of augment that dry powder, you're going to run out of that dry powder in a year, maybe a little bit over a year. Does that sound like a market that's oversupplied to you?
Right.
I don't think. I think people consistently underestimate the extent to which the extent to which private credit is growing, and B, the size of the addressable market,
right,
which banks have whatever it is, $9 trillion in bank loans in the U.S. $3 trillion in leverage loans and high yield bonds. You've got the securitized markets, right? There's a massive TAM here, and I think people, if you're sitting here today, it's it's raised a lot of money. It's like, well, it's also growing very quickly, and we see that on the origination side as well.
Right. I mean, it's a great point too in terms of the addressable market, because banks still hold trillions and trillions and trillions in commercial and industrial loans. And if banks continue to withdraw from that market, to manage the risk on their balance sheets, just a small decline in the amount of C&I loans held by banks is a significant increase in the addressable market from private credit. And so, again, as Andrew said, certain parts of the market are a little bit more crowded. That's really at the kind of large cap private credit segment of the market. And again, that goes back to, rates are a little bit higher, a little bit harder to get deals done, the uncertainty in the market, the risk of inflation that rates stay higher. If we can address some of those concerns, then the amount of dry powder that's sitting in private credit currently probably looks small relative to the deals that'll get done.
And the amount of dry powder that's in private equity.
Precisely. So there are parts of the market where, money's been flowing and more concentrated. There are other parts of the market where money has not been flowing, where the M&A activity is still very strong. Again, that's that kind of lower core middle market, kind of non-sponsored direct lending. But I want to address this question of being crowded because we've had concerns. I think it was about a year ago. We were hearing a lot of concerns, is private credit a bubble? And there is a sense that there's a lot of money flowing to this space. Is it too much? We just talked through why we don't think that that's the case, but that doesn't necessarily mean that it's not a hot market right now in certain parts. But in general, the way that we think about is there too much capital flowing to a space, and it's really the basis of our paper, is private credit a bubble, is that it does not matter as much the channel through which capital goes to a certain segment of the economy. Two companies of similar profile where similar risk is being financed. The question about whether there's a bubble is there too much capital from all channels flowing to that space? And so in that piece, we roll out a chart where we show the size of the high yield bond market, the syndicated loan market, bank, commercial, and industrial lending alongside private credit. And we normalize the size of those markets to GDP. So that way you can see over time, is the credit pie growing? And what we've seen is that since 2014, that credit pie has shrunk. The amount of credit being extended to this cohort of businesses and firms has declined, meaning that there's not excess capacity being created, which would be the concern in a credit bubble scenario. But in fact, underwriting has remained very disciplined. On private equity deals, you see high equity contributions. You don't see leverage levels expanding massively where lenders are trying to get more money deployed. And so what we really think of as the secular growth of private credit is that is a story of taking market share and not increasing market size.
Yep, that's totally right.
So Andrew, that's been a very fulsome conversation today. We covered a lot of ground. As always, we really try to bring it back to what matters for investors. But, your insights on macro, the trade situation, the tax implications, are so important to the current setup and where markets are going to be headed today and how folks should deploy capital. And, again, it's one of those, weeks where it feels like years are happening. There's a lot going on at this point in time, but I know that, we both remain really committed to staying on top of it, providing good analysis for our investors. Yep. And your leadership of the team to that end is invaluable, and I'm sure that our clients and investors are very grateful to have the insights shared today.
Yeah, no, thanks for leading the discussion, Alan. And again, we've got our sort of quarterly, big chart book that we put out called Mapping the Markets. It'll be in the show notes. It's on fsinvestments.com. So please give that a read. And thanks for leading the discussion, and thanks to everybody for listening.
Of course. Thank you, Andrew.
This episode was recorded at the FS Investments headquarters in Philadelphia's historic Navy Yard. It was produced by the investment research team, edited and engineered by Aaron Sherman, video produced by Melissa Venditti, copy provided by Harrison Beck. Special thanks to show coordinators Ellie Zhang and Laura Coleman. If you enjoyed this episode, be sure to like and subscribe wherever you get your podcasts. Thanks for listening.